Welcome back to another episode of Not Financial Advice. Today we're going to be taking a look at TAP stock, also known as Molson-Coors. This is an American international company that's a brewer of beer. So that's going to be most notably Coors, Miller, Molson in Canada, I believe Carling in the UK, as well as several other craft or more regional beers. So let's just jump right into it. I'll ask you to hit like and subscribe, and now we can get started taking a look at this company. So its stock is trading at $60. If we look at a trend line on the company on the screen here, we may have a reason to believe that it is undervalued. It's currently trading at $60. As we can see, that's down 44% from its all-time high. So let's get into this and see if we can figure out what this $60 stock is actually worth. So we're mixing up the format a little bit today, and I want to bring in, throughout these next few videos, some of the things that I've learned from great investors in my investing journey over the last 2.5 years, some highlights or some things that I've learned and have really rung true for me in my experience. So Peter Lynch, if you don't know, he was the manager of Fidelity's Magellan mutual fund in the 70s and 80s. I think he was at it for about 15 plus years. He had great returns, I believe well over 15%. And, he is very much so a populist when it comes to investing. He says that the average investor can not only beat professional fund managers, but they can beat the market. And one of the main teachings of Lynch is to know what you own and why you own it, or in simpler terms, buy what you know. And so, when we're thinking about Coors stock, I've always like I've always liked Coors Light more than Bud Light. The idea to look into this as a company to invest in was based solely on that, personal experience, personal opinion, sample size of one, an anecdote. I prefer the taste of Coors Light to Bud Light. It was a controversial pick at parties maybe 10 years ago, but there's been recent controversy with Bud Light, as many of you know. But my taste hasn't changed. And so when it comes to Lynch, you know, he worked at Wall Street and he went to Dunkin' Donuts every morning or every other morning and noticed the lines getting longer and longer and longer. And so that was a great investment of his. He made a tremendous amount of money on Dunkin' Donuts. Well, Wall Street professionals were probably looking at companies like IBM or GE or Japanese stocks that were trendy during that time. He made money on Dunkin' Donuts. And so I've made a little bit of money on Coors stock. So let's get into it. We're going to do a fast market update before we get into the fundamentals and figuring out what the value of the $60 TAP stock is. So today, the market was up 0.9%. It's going to be the 28th of the month, 28th of November, 2023. Market was up 0.9%. Update on my portfolio, I was up 0.21%. So I had a nice day of outperformance in the market. And now we are back to Qualtrim, where we always start our analysis of companies. I'm going to ask you to like the video and subscribe to the channel again. And as always, Qualtrim is a great website. It's a suite of software I pay for to look at stocks, but not one that I'm affiliated with. So I will leave a link to Qualtrim in the description below. So getting right into this, looking at Coors, I'll refer to TAP stock as Coors for the rest of this video. So Coors has a $13 billion market cap, which makes it a smaller large cap stock. They have a forward PE of just under 13, which is cheap. They have a really high free cash flow yield of 10%. That could be a warning. That could be a warning sign. There's a sweet spot with the free cash flow yield, maybe somewhere between 2 and 8%. And if people aren't willing to pay for the free cash flow of the company, there might be other things that they see in its future that they're concerned about. But I own it, and I'll lay out the case to you why. Not a disclaimer, but this isn't financial advice. But I'll just sort of take you through some of my thinking on the stock, things that are good, things that are bad. Um, so it's got a current payout ratio of 2.73%, which is not sustainable. So this company has a pretty decent starting yield, just under two times the market. And there's sort of a problem with the dividends on this company. So dividends are growing right at the rate of inflation, but we can see that they've cut dividends twice in their history over the last 35, 40 years, 35 years. So a company that's cut a dividend once is likely to cut its dividend in the future. So I would definitely not buy this stock based on its dividend. But right now, the dividend feels good, but it's not great because they're paying out more in dividends than they're getting through earnings per share. So this is going to be the first and a big red X mark on this stock. We'll go out of order here, and we're gonna look at it. So I was doing a little bit of investigation here. I believe an acquisition happened here at some point, but we're looking at shares outstanding now. And so this company issues shares, and they issue shares 1.78% over the last 10 years. So it's more than 1% a year. That's a big red X check mark on this company again. So not starting off the best for this $60 stock, of course, um, here. But from what I've been able to tell, definitely don't take my word for it. They have grow they have they have substantial free cash flow, but their dividend payout ratio is high. So I believe that they are paying paying for their dividend by issuing new shares, by diluting current and past shareholders. So that's obviously bad. Um, this is going to be a red X mark. And let's switch it up and come back and look at some of the things that are positive about this company. So, revenue on an annual basis over the last 10 years, its growth is at 11%. Um, and I think this is a company that makes acquisitions. Um, and to be honest with you, it's a company that's had some problems. So one of the things is this company was hacked at least once, which significantly affected their performance in revenue for a whole year, and um, really weighed down on the price of the stock and the sentiment on the stock. It's something that happens to a lot of different companies, and I've mentioned it once before. Maybe it's the reason to look at the cybersecurity space moving forward. But the revenue on this company, although it's up into the right, it's choppy, and a lot of this looks like it's based on some acquisitions or some divestitures of different companies. So this is a check mark because the revenue is up into the right over the last 10 years. Um, but this isn't the best looking revenue chart I've seen, to be completely honest. Let's also take a look at free cash flow. So, what we see when we look here is that the free cash flow over the last 10 years is up and to the right, under a percent. And there's a downward trend in the free cash flow. Um, and so that's obviously not ideal. Um, I think that we could have expected that in 2020 or 2021. And we don't have all of the most recent figures, but we would have liked to have seen a strong rebound here in the price of this stock and or in the performance of the stock on a cash flow basis as things have normalized. We're not seeing this. This will be a check mark because you know they're doing they're doing plus or take about $1 billion a year in free cash flow. So the presence of free cash flow is here overall. It's up into the right, but there is a recent downtrend. So this will be a check mark, but not a very strong one necessarily. At the same time, $1 billion of free cash flow a year is nothing to sneeze at. So let's keep on looking at different things that matter. I'll ask you at this point to like and subscribe to the video if you forgot earlier. Let's look at the cash and debt position of the company. So they have a significant amount of debt. I believe they have about 10 times as much debt as they do cash. Although they've been making a strong effort to pay it down. Um, they do maintain cash, about a 10-to-1 ratio. So I like that they're paying down their debt. That's fantastic. This is usually a little bit more accurate. So something like $600 million in cash and $6 billion in debt. So it's a 10-to-1. The ratio is too high. I mean, uh, this has to be a red X mark in evaluating this stock. But I will note that this paying off of debt is a very, very positive, very positive trend, and it might be part of the catalyst that's had to do with some of its recent performance is significant, success in paying down debt. They obviously have some sort of plan to do that there. Um, Now, let's take a look at Molson Coors Tap. Again, Coors stock. Let's take a look at their ability to turn debt and equity into profit. So it's an average, in the high single digits, but it's under 10%, so that'll be another X mark on this company, um, and we don't necessarily see a great trend here, although it does look pretty stable around this 6 or 7% mark, so unfortunately, that's gonna be an X on this company when it comes to, profitability. We're also gonna look at profit margin. This looks absolutely horrible. A couple percentage points bottom line profit margin in the last couple of years. That's an X mark as well. Not looking the best. Let's look at expenses. So their expenses are going up. It's a red X mark. Their expenses are going up. Not looking great. I believe this will be the last metric that we look at before we continue with this presentation and get you the answer to the question, what's a fair value for core stock that trades at $60 a share? Looking at its relative PE valuation over the last 10 years, it's usually lived around the 15 PE. mm, it's usually lived somewhere around the 15 PE line. You can start to see that trend. Sorry if that's distracting. Um, Maybe live closer around the 12 PE range, but they've had recent negative earnings. So I'm just have to make this out to be a dash. With the problems they've had with earnings per share, I guess it's not going to be a very reliable metric. Let me see there. So that was an X. So we do have some more data here, and this is always a good sign. So what we can see here is two purchases by a member of Core's board. So $6,000, $8,000, $11,000. So just under $20,000 in stock buys, in this 50 50 to 60 $55 range. So we've had nearly $20,000 of stock bought by a member of their board, and the only reason that insiders buy a stock is because they believe the price is going to go up. That'll be another quote from Lynch. So we've covered everything that we need to look at here. Um, Before addressing this slide, I'll ask you to like and subscribe to the video, but I want to take a second out, and just commemorate the passing of a great investor, Charlie Munger. Passed away today at 99 years and 11 months old. Um, and if, Munger is Warren Buffett's right hand man, his lieutenant. He's someone that taught Warren Buffett to stop buying cigar butts of a company that you can get one or two puffs out of, companies that are trading very, very cheaply. And he encouraged Buffett to buy a great business at a fair price because that's superior to a fair business at a great price. Again, for instance, Buffett would say Apple was a great business at a fair price. And that's better than buying a fair business at a great price. And so Munger is and was a 50-50 partner to Buffett, and 50% of Buffett's success, I would say, although he was a quiet guy, always took the back seat. Um, he called it like he saw it. He didn't hold anything back, no holds barred, but he was a man of very few words. And when he did speak, people listened, with quips or, you know, quips, sarcasm, wisdom, humor, intelligence, a dry humor. And so he lived to be 1 month short of 100 years old as a multi-billionaire. I think that Munger would, he'd have something funny to say that he was a month away from being 100. I think that he liked that. So rest in peace to Charlie Munger. We'll move forward. So looking at Coors, their investor presentation, this is something that's important to know. So they're in the United States with Coors. They also own Miller as well as some other brands. But in Canada, they own Molson, which is essentially the Budweiser of Canada. And then in the UK, I do believe they own Carling. I may be mistaken, but they're really proud of this new brand they have, Madry, which is the um, number two craft beer in the UK, but it looks like uh, Tap is the number one brewer in the UK in both volume and volume share growth. In Canada, they're reporting share growth in every region and segment. And in Canada, Coors Light is going to be its number one position. Um, Miller Lite is seeing growth in Canada. In the US, Coors and Miller, owned by Tap, compete obviously with Bud and Bud Heavy, and now brands like Modelo and uh, Corona. But there's not a bar or a restaurant where you won't find Miller and Coors on tap or in bottles. So overall, Tap is the third largest brewer in the world. And I think after them, the capitalization drops off pretty severely. So they're a major player, and in different regions they lead with different brands. So Coors Light, Miller Lite, Coors Banquet, Miller Genuine Draft. They also own Peroni, which is a decent beer. Molson, which is a decent beer. Pilsner's a really good beer. Foster's in Australia, so that's interesting. Red's Apple Ale, a cider. Henry's Hard Soda, hard more hard cider, Steel Reserve, Blue Moon, Leinenkugels, which is a great brand, and then some budget brands: Ice House, Milwaukee's Best, Keystone, and Miller. But also again Blue Moon. So then some really great brands that certainly aren't going anywhere. So we'll take a second here out just to look at my relationship with this company. Besides drinking their beer, I earned about $514 of this stock. I'm up a little bit. I own it. And so that's not a spoiler for what valuation we're going to see. We have a $60 stock for Coors beer. Let's see what we can do using the metrics that we took from Qualtrim to get an understanding of the fair value of Coors beer stock on a per share basis. So this was the most uh, recent data I had recorded for the free cash flow over the last 5 years. 1.1 billion total cash on hand uh, at the time of me capturing the information was around a billion, around 6 billion in debt, 201 million shares outstanding, and based on that 10.7% annual growth rate, and accounting for its choppiness and other considerations, I've put its projected growth at 6% over the next 5 years, down to 4% over the next 10 years, with a terminal growth rate of 10% and a 10% discount rate. Price of the stock, $60. My rough estimate of fair value on core stock, $75. So Is this company a cigar butt or a value trap, or is it a decent investment with a good chance of turning around? I'm not exactly sure, but I like the category of consumer defensive. They have substantial free cash flow and brand value, and they're paying off debt, and so it's less than 1% of my portfolio, and so even though I'm showing it as undervalued, it doesn't mean that the price can't go lower. But I'm happy to hold it today, and I'll thank you for tuning in. Ask you to like the video, subscribe to the channel on the way out. Again, this is not financial advice, and I will see you on the next one.